Good afternoon, ladies and gentlemen. I welcome you all to the first quarter of financial year 21 earnings conference call of Minda Corporation. I would like to thank you all for joining us on this call and hope all of you are doing well. The first quarter of fiscal year was an unprecedented period, not only for the auto industry, but for the whole economy. The auto sector globally was severely impacted by the pandemic COVID-19 and continues to face headwinds due to general economic slowdown. The first half of the quarter did not see any activity, and production and sales only started in safe manner from later part of May. This has made the quarter incomparable with previous periods. Now with the gradual opening of the economy, we are able to see green shoots in the certain segment of industry, especially in two-wheeler and tractors. In these challenging times, Minda Corporation reported consolidated revenue from operation of rupees 1,780 million, a decline of 69.5%. We believe this is better than industry numbers, which lesser than the industry low value. To minimize the impact on company's financials due to significant fall in industry volume, we have taken numerous cost reduction measures, optimism of capital expenditure, and efficient working capital management. There are clear indications of economic activity picking up from June 20 onwards, and we are consciously optimistic of better times ahead for Minda Corporation. This is further supported by the fact that currently more than 50% of our revenues comes from two-wheelers and tractors. Additionally, aftermarket and export are also showing speedy sign of recovery. Minda Corporation continue to remain close to its customers to better understand and meet their requirements during these trying times, which will be explained further by our Group Marketing Officer, Mr. Neeraj Mahajan. Now, we shall begin detailed discussion on financial and operational performance for the quarter. With this, I hand over the call to Mr. Lakshman, our Group CFO. Over to you, Lakshman.
Thank you. Thank you, Mr. Minda, and good afternoon, ladies and gentlemen. Hearty welcome again to the Q1 results FY21. I will take the assistance of the presentation that we have uploaded on the website, and I'll be referring to the slide numbers for those of you who have the presentation in front of you. For others, I will surely read out and explain from the slides that are there in the presentation. Thank you. I'd move to slide number 3 of our presentation to give you a quick overview of Minda Corporation, diversified product portfolio, global customers, very strong manufacturing, advanced R&D, and now more than 6 decades of automotive experience. The items on the left are you're familiar with. We have a 2,800 plus crore revenue. We have 4 business verticals, marquee customers, and 30 manufacturing facilities, R&D capabilities, and our current market cap is about 1,660 crores, 1,660 crores. On the right-hand side, we have a revenue breakdown for Q1 FY21. You will notice that the outer ring is the revenue chart for the current quarter, which is Q1 FY21, and the inner ring is for Q1 FY20. If you go by geography, you will notice that India contributes now about 80.6% of our entire revenue pie, as opposed to 85.3% the same quarter previous year. I'd like to mention here that for comparison purposes, as well as in line with Ind AS 105, we have made the comparison apples to apples. It does not include the European operations which are discontinued. So without them, our India revenue pie was 80.6% now as compared to 85 earlier. Our Europe and North American revenue by geography has increased from 9% of sales to 12.2%. And our Southeast Asia has increased from 5.7% to 7.3%. More importantly, if you look at the right-hand pie chart, which is by end market, you'll notice that the 2 and 3-wheelers have moved up from 51.7% to 53.3% in terms of our entire revenue pie. Commercial vehicles has significantly fallen from 30% to 20%. This includes tractors, and the breakup between commercial vehicles and tractors is 13% is contributed for this Q1 from commercial vehicles and 7% is contributed by tractors. The aftermarket has grown significantly. Last year during the same period, it only contributed to 10% of our pie. This quarter, it has contributed to more than 20% of our pie. Going by business verticals, which is the pie chart on the bottom, the Mechatronics contributes about 43%, and the aftermarket is another 20%. So both included, our Mechatronics plus aftermarket contributes about 63% of our turnover, and information and connected systems contributes about 36.7%. The India Interior Plastic Division is included in this 36.7. As of now, it is a small number. I will move to slide number 4, and you are all aware of the industry situation today, but a quick recap on slide number 4, you will see that overall, the auto industry has fallen by 78.4%, of which the two-wheeler market has fallen down similarly by 78.5%. The industry fell by 78.5%. It will be important to point out here that our two-wheeler business fell by about 69%. And it's significant for us because roughly, as I mentioned, 53% of our turnover in this quarter has come from two-wheelers. Passenger vehicles has fallen by 84%. Three-wheelers has fallen by 76%, and commercial vehicle has taken the largest fall, which is at 87.6% in Q1. Tractors have fallen by 40%. Just a point to note here is that if I had adjusted our revenue to the same mix as previous year, then typically my sales should have fallen by about 81%. However, because of the new mix as well as the fact that I'm more towards two-wheelers and my own fall in two-wheeler has been less than market, our overall fall has only been 69.5%. Coming to the financials on slide number 5, that's the consolidated financials for Q1 FY21. As Mr. Minda mentioned, our operating revenue was 178 crores, which is a 69.5% fall. We have another income of about 9 crores. That's basically the interest income we have on our funds that we have. Our Ebitda negative was at 20.3 crores. This is substantially contained, which I will come to in the next few slides, contained because of our aggressive push on fixed costs, keeping fixed costs down, specifically things like employee costs, other expenses, etc. Our profit before tax was about loss, which was a loss for continued operations, which was 45 crores. And then because of deferred tax credit, our profit after tax from continued operations reported on a consolidated basis is 36.3 crores. We had an exceptional item. We had a profit from discontinued operations of about 90 lakhs, and therefore our final PAT was a loss of 35.4 crores. As we mentioned, our previous quarter's numbers were way significantly different, and so was the same quarter in the previous year. and comparisons doesn't immediately make sense. However, they've all been adjusted for comparing it to related items because, as we said, as per Ind AS 104, our accounts have been restated and this table excludes our discontinued operations. On slide number 6, we have the chart illustration of the same numbers. However, the commentary is important for us to share with you. Overall, the 69.5% decline in the industry is mainly was cushioned for Minda Corporation because we got a slightly better than industry numbers for aftermarket, which degrew by only about 42%, and our exports, which degrew only by 55%. And this degrowth also is largely because of the postponement of demand and logistical challenges in the business. Our Ebitda decreased because of non-absorption of fixed costs, because you will notice that we didn't do any production or sale for the month of April and for large part of May. And of course, we had an unfavorable product mix because commercial vehicles took a big hit. However, we have come back with very strong countermeasures. We have reduced employee costs significantly, and we have lowered other expenses also significantly in this quarter. If you see our standalone and consolidated numbers, you'll see a big fall in our employee costs as well as in lower other expenses. However, maybe half of it can be attributable to lower sales itself, and at least 30% of that we think we should be able to sustain going forward in the current year, which should benefit our profitability. And number two, we should help lower our break-even point. Our net profit was negative because of course, negative Ebitda. And the other reason our net profit was negative is that on a consolidated basis, we also absorbed a 5.8 crore loss as our share of our joint venture profits, mainly Minda Furukawa, Minda Stonebridge, and Minda West. If I move to slide number 7, now we have the same numbers but split between Mechatronics and aftermarket in one bucket and information and connected system in one bucket. The revenues in the Mechatronics business came out at 112 crores, which is a 61% drop, and the Ebitda was about 9.8% negative. Of course, this degrowth has a little bit been cushioned by a lower fall in exports in aftermarket, as we mentioned. Our overall fall in Ebitda has also been cushioned largely by various cost-cutting measures. Our information and connected system has fallen by 77.5%. Of course, a huge fall in commercial vehicles by about 80+%. Revenues came in at 65 crores and Ebitda was negative about 14.2%. It's been fairly impacted by the decline in CVs, and also we have had mixed challenges with respect to product mix in the information and connected system business vertical. So that's the overall financial numbers we have. So to sum up, our fall has been lesser than industry, number one. We have been fortunate because of the two-wheeler mix that Mr. Minda mentioned, and we managed to contain our Ebitda losses of about 20 crores because of strong cost-cutting measures that we have taken. The other positive, of course, is we have managed to improve our cash flow position during the quarter in spite of COVID. So that's the positive. And with this, I would like to hand over the presentation to Mr. Neeraj Mahajan to give us a quick update on the business performance, order book, as well as what we are doing new at Minda Corporation. So over to you, Neeraj.
Thank you, Lakshman, for giving a quick number update. Good afternoon, team. This is Neeraj Mahajan. I'm President and Group Chief Marketing Officer for Minda Corporation. My overview is mainly on two accounts. One for the order book, which I'm going to first talk about. While the the entire industry has been, struggling first to come to terms about the volume drops, lockouts. But one interesting thing continued during last quarter was auto industry purchase teams work from home, and we are very fortunate that we have been able to book some very exciting orders during this time. I would just confirm that I would say that this is a very healthy pipeline which we have generated during this time, and let me confirm that this is divided into 4 sections. Our Mechatronics, which is business vertical 1, information and connected, which is BV2, plastic division BV3, and other and exports. So let me cover the Mechatronics one. The overall lifetime order book during Q1 is close to about 397 crore. This is very exciting for us because we got in this 3 very large orders. One which is coming in for die-cast from a two-wheeler business customer, and lifetime business in this case is close to about 204 crores. We also receive a very prestigious order for our joint venture partner with VAST from Pune. This is also a lifetime order of about 56 odd crores. This is coming. These orders are all coming in now for programs which are either to start in, let's say, 2021, 2022, and so on. The third order for our continued business focus to improve our profitability is coming in on the starter motor and alternator, which is currently, which we have spoken sometime is not supporting us as much, but we have started to see traction there with thanks to the management focus which is coming in and bringing, various activities to not only bring down the cost but also to improve the quality and engineering aspect of it. So lifetime order there has added about 17 crore odd, and we have very healthy pipelines for RFQs in BB1 further. ASEAN business has started to be a very clear focus for us, and during the number breakdowns you may have noticed, while this has been a challenge now, however, we have clear orders coming in from one of the largest two-wheeler global player, which is about 15 odd crores of business, which is booked during this time, and team has done a great job there. This is a combination of, the next generation lock sets, which also conveys that customer is showing confidence in our future technological product, which we are now developing or demonstrating through tech shows and product exhibitions. On the BV2 side, which is the wire harness and the sensor division, we got the award for a very large order from leading tractor maker for about 45 odd crores. We also won sensor two-wheeler OEM for a very large, the largest two-wheeler customer for about 180 crores. This is very exciting business award again. And also we got, the next generation cluster activity, which is starting with about 20 odd crore rupees business coming in from north side, the leader in tractor industry. Another instrument cluster for two-wheeler, which is now the new generation instrument clusters. We have started to see the traction. That order is about 15 odd crore rupees coming in from one of the India's most popular two-wheeler company, Indian brand. Now, we also saw a very good traction of about 134 million rupee revenue orders coming in for light-weighting plastic part from largest passenger vehicle maker or Indian manufacturer, which is for the combination of passenger and commercial vehicle application. We are excited. This order is something which we were, focusing upon to grow our portfolio for Indian plastic parts, which after KTSN is very important for us to, get traction from our customers. Export is one thing which we are continuously focusing, and I'm happy to share that there are 2 important developments. One in terms of wire harness, which is for the European largest two-wheeler maker. There, just to highlight a point, which is the wire harness is for Euro 5. So that means customer is accepting Minda Corporation, competency of the product in the future, model introduction. And also, I think I briefly touched upon this point last time. among the India's largest, four-wheeler maker. We got the, a very, very prestigious entrance of our new technical agreement technical agreement partner. In fact, the shark fin antenna, which is going to be, I think, a new, let's say, beginning in terms of Spark Minda's entry into a new product segment. This is about a 50 crore rupees order, and the supplies will start from 2022. What we are doing towards the technology, I'm going to the next slide. There we are very clearly looking at, in the commercial vehicle, we have seen the traction of, the commercial vehicles, especially the buses, becoming more visual in terms of its displays. So our intelligent transportation system architect has started to get good information, intelligence system which is being developed now. And I'm pleased to share that we have already received the trial orders and the supplies are starting on this subject with among the top two bus makers in India for road transport authorities and public transport system. This is something which we would like to expand going forward in terms of our technical competence, which is prevailing on airports, on the railway stations, because government is very heavily focusing on it. It is just a matter of money released from government side, and we are going to partner with them in these areas. That's one area we are also looking at. Also, in terms of our, I'm very excited to share that two-wheeler, we are going to be the first company in the country to start supplying the first keyless entry system in two-wheeler OEM. This is going to be for the first EV, two-wheeler EV maker. And our engineering team from SMIT has developed the components through which we have also patented 21 parts for showcasing our technology. So I think this is very exciting development, and I would like to congratulate my technology team for seeing the the research work moving into the productionized area, and we should be able to see the supplies. The SOP has just started, but the volumes are a little bit on the ramp up stage because of the COVID, but we will see those numbers growing gradually on this subject. This is going to be one big development as far as Minda is concerned. This is first keyless entry by any Indian maker, and we are there for this. Design and development on various range of DC-DC converters. We have already got into this subject with two-wheeler as well as commercial vehicle space, and we are right now in advanced discussion also for taking that matter forward with the horizontal deployment across the industry, offering our already well-developed product which is well accepted and proven. In terms of our assistance, I just mentioned about shark fin antenna of INFAX South Korea. We are now in active discussion apart from the shark fin antenna for RF and LT antenna, which is pole type also, to offer to other leading passenger manufacturers starting from all programs which are starting from F22-23 onwards, so that Spark Minda should be able to supply this high value added product to these customers, because pole type antenna is going out of fashion, and you will see most of the car companies are getting into shark fin antenna from now on. So it is going to be almost a hygiene, if I may say, and we are fully geared up to take care of this part to be offered to all the leading makers in the country, and we have very strong partner in this case. I would like to summarize this on both aspects. Order book for Q1 is very good at this point of time, in spite of COVID, I would say, because Spark Minda team tirelessly worked during this time, assisting customers to close the RFQs. And during this time we could get some breather on the other activities to convince customers on our unique selling points, differentiators we call it. And on the technology side, SMIT as well as our other engineering members have done exceedingly well during this time, and we are very confident with the strengthening of team, which Mr. Minda will also touch upon or may have touched upon during the call. We are getting future ready on account of our technological push for 2022 and beyond. I would like to rest my explanation here, and I can take question and answer later. So, Lakshman, back to you, please.
Thank you very much, Neeraj. And President, over to you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The first question is from the line of Ronak Sarda from Systematics. Please go ahead.
Hi, Lakshman. First question on the capacity utilization. So what would that be in 1Q, and how has that changed, let's say, in July and August? So what would be our utilization levels now? And part 2 of that question is, the cost measure. How are costs increasing as ramp up is happening? Are we seeing substantial benefits once we are around, let's say, around 80-85%?
Sure. So I will answer the first part of the question, and then I'll request Mr. Minda to give his views on July onwards. We tried our best to measure capacity utilization for Q1, Ronak, but then we gave up because it has to be then measured month on month. Because an average gives a very different picture. So, for example, April was 0. May was a very small number, and basically from June that we started ramping up in terms of our utilization of capacity and then going ahead. So it will be fair to assume that in June it would have been roughly say 50-odd%, and July the number is again significantly improved. That's the quick take on the measure, Ronak. I'll come to the cost in a minute. Mr. Minda, if you'd like to add anything on this question.
So as you asked, Ronak, about July onwards, yes. OEM, particularly in two-wheeler, as well as the tractor segments, that and we exist deeply in these two segments, and there we are. This segment is definitely helping us during this time, and this is continue to happen. At least I am seeing till the time of the festival. Then we will see after the festival time, and the aftermarket is in June. We have increased 18% the growth in comparison to the previous year, and same is in the July. So we expect to catch up significantly in Q2 financial year 21. This is what is I think so.
Okay. So roughly, Ashokji, would it be like almost 85% on an average versus last year, our revenue run rate for July and let's say mid-August?
We are thinking the overall it will be, if the something does not happen adversely, but definitely it will be 70 to 80%.
Okay, great. Yeah. Okay. Lakshman, on the cost part?
Yeah. So, Ronak, on the cost front, the measures we have taken are fairly significant in terms of how much of reduction we have been able to get in fixed cost as well as in our personnel cost. My estimate is about 30% of this reduction we can carry through for the rest of the year as well, because a lot of the personnel and other admin costs, etc., in a sense are also variable. So I would put the number at roughly 30%, Ronak.
Okay. And the most important is how to each business is this is the time how we reduce the break-even point. That is what is an important area.
Right. Right. And Lakshman, I mean, we used to have significant contribution from commercial vehicles as well, and last 2 years have been very challenging. So I mean, were those products supplied to commercial vehicles more profitable, and or is recovery in commercial vehicles, if it happens from H2, will that be a significant contributor to profitability?
I'll answer the question first, Ronak. And I'd like to let Mr. Neeraj Mahajan talk about the commercial vehicle pickup. Only thing, yes, in terms of my share, last year commercial vehicles were 30% in the same quarter, and this year it is significantly reduced. So the answer is yes. Though the profitability in terms of Ebitda margin has been similar, if you look at last year's presentation on business vertical 1 and 2, largely similar. However, the bulk was being offered by commercial vehicles. So yes, any recovery in commercial vehicles will help us quickly absorb our fixed cost. That's on the costing side. Over to Mr. Neeraj Mahajan on his outlook for the commercial vehicle segment.
Thank you very much, Ronak. To me, well, we have been very closely interacting with all leading commercial vehicle manufacturers, because almost 100% of them are our customers. Market outlook as of now, I would say, is gloomy as far as commercial vehicle is concerned. So if recovery, if at all, for example, the recovery it is expected, they are not even speaking about it for this year. So I think everybody is expecting about 30 to 40% drop on the annualized basis. So I would not give very optimistic opinion or picture about commercial vehicle at this point of time. While we are, as Mr. Minda also mentioned, there are some green shoots of segments like two-wheeler. I think the most exciting segment right now is tractor. We are not able to meet their demand due to social distancing right now. They are going 2.5 to 3 times their volume requirements compared to 2017-18. But commercial vehicle, I'm afraid after last year drop of about almost high double digit, we are still expecting further drop this year is overall market going forward for commercial.
Sure. Thanks, Neeraj. And final question on the KTSM business. Any update there? I mean, is a large part of the liquidation done, and or any update?
So
the payments have happened from our side, which
yes. We have that part is now behind us, and of course now it's a process, and that process will take time. However, the obligations that we had in terms of what we had to complete by June, yes, we have done what we mentioned.
Okay. Thank you, and all the best.
Thank you.
Thank you. The next question is from the line of Chetan Jindodia from AlfAccurate Advisors. Please go ahead.
Hello, sir. Sir, can you explain me how the order book works? So you have given the lifetime value of orders of this year is 4,250, and last year fourth quarter was 7,350 crores. So our order book has declined this year, and how, or this is the value of new orders that we'll be executing in 1 year. Is this the annual value, or how should a lifetime value order should be looked at? Is it 2 years, 3 years? What is the time frame for it?
Lakshman, can I take this question?
Absolutely.
Thank you very much, gentlemen, for your question. Lifetime order is typically considered between 4 to 5 years, depending upon the program life of the project which is confirmed by the customer. And first year is typically the limited number of months based on the start of production SOP date and the balance months left in the financial year. That's how we normally calculate onto this. This is how the methodology is adapted.
And the order book has declined from last year. So how should we look at this then? How should we read this number? Hello?
This is not, sorry, I think let me reconfirm that. The order book does not mean that this is not revenue. This is the new orders which are received during this quarter. So this is nothing to do with our past revenue at this point of time.
Okay. And in the two-wheeler wiring harness business and also the CE wiring harness business, we were supposed to have a big addition in our kit size, and the value of our sales was expected to go up. So can you give the breakup of how much was the increase in two-wheeler wiring harness in this quarter and also in CV?
So I'll come back to you with specific numbers. However, there are 2 points here. One is it is yes, the two-wheeler wiring harness kit value we had said will more than double. That thesis continues, and it was expected to actually show quantum results as we go forward in the future quarters. In the Q1, why you're not able to significantly see the differences, because the BS6 to BS4 mix, if you put it roughly, it has still been only roughly about 50%, because majority of the BS4 still came in due to exports of the OEMs. So that is one clear point. And the second point is, of course, there have been ramp-up challenges with respect to BS6 at all the manufacturers' ends and at our ends. And therefore, a more clear comparison, or at least the visibility of that bulk up of kit value, will be more clearly available in Q2 and Q3 going forward. That's the quick response.
Okay. And in terms of decline in gross margin that we have seen in this quarter compared to last quarter, so what has led to this?
The absolute fall in the revenue has significantly dented this, so it doesn't make it comparable at all.
Okay. So going ahead, we should be back to our 38-40% is what we should reach.
Yeah, as we ramp up, yes, we should, and our hope is that we will catch up faster than probably what was usually expected, because like many other players, we have also very aggressively worked on our fixed costs. So if we were to reach the goal in X months earlier or X number of quarters earlier, we hope to reach that goal faster now.
Because we were not expecting that the recovery will be so faster than we are seeing in two-wheeler and tractors. So during the COVID time, we were thinking that the second quarter will also be very much concerned. So, but the things are not like that.
Okay. And last question, in terms of employee cost, we have seen a very sharp reduction. So should we expect the employee cost in absolute number to remain at this level, or will it be more of linked to the revenue and should be back to the 90-120 crore run rate from next quarter?
Sorry, I missed that.
Our employee cost has declined to 54 crores from 96 crore last quarter. So so is this employee cost reduction likely to again go back up with the rising revenue, or is this a more sustainable reduction? How should we read into this?
So roughly 30% of it we expect it to be little sustainable, a very rough number. because our employee cost has a mix of variable and factory workers as well as staff cost, etc. So all the cost-cutting measures we have taken on the personnel side, we are expecting about 30%, 25-30% of this to remain sustainable.
Okay. Thank you, sir. Thank you for the details and all the best.
Thank you very much.
Thank you. The next question is from the line of Abhishek Jain from Dolat Capital. Please go ahead.
Good evening, sir. Thanks for taking my question. So just wanted to understand what is the current status of insolvency process of Minda KTSN. Has it completed?
No, it is only started now. An insolvency administrator, we believe, has been appointed, and it's a process that will take its own course, and it's very, very established process that they will go through. So it's a work in progress. It may take some time.
So how much debt will reduce post completion of this process?
So the debt that has already the debt numbers have already been reduced, because now our consolidated numbers are without the numbers of KTSN. So today, roughly, our consolidated debt looks at about 394 crores.
394 crores. Sir, my second question on the debt part, that your interest payment is around 50 crore annually, which is around 38% of your EBIT, despite the sufficient cash in hand. On the other hand, you are earning only 26 to 28 crores as interest income. So you are losing significant amount of interest every year. So just wanted to understand your thought process behind to keep the money for future acquisition, and how this will be fruitful for the company's profitability.
Yeah. So 2 points that you've highlighted. One is the negative carry that we call with respect to keeping the money at a lower interest rate. And second is you're talking about the strategic intent in terms of to do with the money. So the strategic intent, I will request Mr. Minda to answer. But before that, on the finance side, I'd like to say that, of course, we have kept the powder dry, and there is a small cost to keep that, and an incremental cost could be about 1% of the amount of total deposits I have. Strategically, it's worked out very well for me now, because we have dry powder available in case the management and the leadership decides to take a call on synergistic acquisition opportunities. And I'd like Mr. Minda to comment.
Yes, we have decided strategically to park this, because we raised QIP, and the vision of the QIP was to invest for our future growth plan and for the inorganic growth. And we have decided not to use this one putting in the system. And we are continuously working for using this QIP funds in an area where we are not doing any fast investment. So that is why we have decided, although we also know that we are losing somewhere some minor percentage of the interest, but we have decided that so that the more working capital which we are using, there will be a pressure with the businesses to be more efficient to take out the funds from the working capital. That was the strategic call to keep this funds in hand.
So are you looking to make any repayment during FY21 or 22? As the current situation, capacity utilization is quite low, and you are losing significant interest also, and your EBIT is also quite low. So just wanted to know on this.
So what is the first part? Are you looking at what you said? Repayment, did you say?
Repayment of debt.
The repayment of debt is naturally occurring because of the tight cash management, and thanks to inputs from you gentlemen, we in fact had a very tight focus on working capital, and because of that we have managed to generate funds to repay debt. In fact, during the COVID period of first quarter also we generated cash surplus. So we are expecting debt to naturally go down by this. We don't expect such low EBITs to continue. Q1 is not probably a right extrapolation for the rest of the year. And so that's where we stand. And in fact, today also as we speak, our cash position should be roughly equivalent to the debt we have. So if you look at it theoretically on a net debt basis, we should be zero.
Okay. My last question is related with the two-wheeler locking system. So just wanted to know your share of business with the different OEMs. Have you won any new business, or have any increase in content per vehicle post BS6 implementation?
Over to you, Neeraj.
Can you please repeat the question? I missed that.
So just wanted to understand share of business with the different OEMs. And just also wanted to understand, have you won any new business or any increase in content per vehicle because of the change in norms from BS4 to BS6?
Yeah. So for sure, in case of wiring harness, there is a content increase. In case of share of business, I think we have segment to segment and even in that program to program differentiation. So I think it's exhaustive this thing. If we talk about, we will have line items of about 100 plus. Maybe I can understand your question later, and I can ask Bikash to specially provide you that information for specific segment if you are looking for. But in general, for a share of business, if we talk about for two-wheeler, we are in a strong commanding position when it comes to the top three in case of wire harness. I would say in most of the places, depending upon program, we are either holding about 70 to 80% of the share of business in, let's say, leading maker 1 and 2 and 3, or at least 50% in most of the cases. So it depends the product which we are referring to here.
And what do you say?
And as I explained last year that we introduced the key account management to give the focus on the specific 8-9 customers where we can increase our per vehicle content, and not only the per vehicle as a whole, the per vehicle, the customer-wise, model-wise content, how we can increase as a group. So that is how we are giving focus. So as we have mentioned, there are a list of products, list of models, how much we have that model, how much content we have, how much we can increase. All that is how we said there are a list of items where we wanted to increase per vehicle content.
Okay, sir.
To give you comfort, I can just share one input with you. Okay. If you see, most of the two-wheelers today are becoming from mechanical or mechatronic products are moving into connected, and also in terms of keyless. The value addition in such cases from Minda Corporation is going to increase, and that is going to increase the value per or kit value for each vehicle what we supply. And our main focus right now is to make sure, which I have explained in one of the slides, for let's say DC-DC converter, keyless entry system for this. And we are right now very deeply connected with some of the new startups with whom we are discussing for their requirements. We have one of the startup which is going to start its startup production in October month for their two-wheeler EV in Netherlands. So there we have got various products which we have started to also discuss with various startups here, and also the two-wheeler which is in advanced stage of EV entry into the country. So I would say that kit value will surely increase going forward as electronic components and content is going to increase, because that's where SMIT focus of development and also the return is going to happen.
Okay, sir. Sir, my last question is related with the share of business with the Bajaj Auto in two-wheeler locking system.
I think specific clients it will be a little unfair to probably discuss. But Neeraj, over to you in case you would like to add any comments.
I think I can see some of the members of competition in the call, so I would avoid such questions.
Okay.
No, otherwise, we are not losing any. This is on the positive side, but not an issue. Which was not any issue with Bajaj.
Okay, sir. No issue. Thank you.
Thank you. The next question is from the line of Sachin Kasera from Swan Investments. Please go ahead.
Yes, sir, just one question on this cost cutting. So if you can just quantify that will be of the total cost cutting, you mentioned some 30% is sustainable. So if you could just quantify that one on the employee front, and secondly, have you also taken some significant cost reduction in the other expenses? And if you would quantify that also, which is sustainable.
Yeah, sure, Sachin. Thank you. Sachin, on the staff cost, I'm talking about within the overall employee cost, there's staff cost also, and within that, in staff cost, we have reduced about saving about 12 crores in this quarter. That's the specific number that comes to mind. And if you see the other variable expenses, that has gone down by about 33 crores. So out of which, again, about 30% of that is something which we think is sustainable.
So broadly, we have been able to reduce the cost by around 80 to 100 crores a year, which is a sustainable number. Is that better way to look on a normal to normal basis?
It may not be fair to estimate it for the whole year.
Mm-hmm. Okay. Thanks.
Thank you.
But there are some area of cost which will definitely continue. That is what I said. It helps us to drop it down our break-even point, and that there are various heads where we have reduced the cost that will help us to continue.
Thank you. Ladies and gentlemen, we'll take the last question from the line of Chirag Shah from Edelweiss Securities Limited. Please go ahead.
Thanks for the opportunity. My first question is on shark fin antenna. So if you can just share some more light, how big is the opportunity size in general, and are you the sole supplier or a tier 2 supplier in this? And is it for a single model as of now, or is it for multiple models?
Okay.
Your voice is not very clear. Let me just comprehend the question which you have stated. So if you confirm me, then I'll proceed. One, you stated if the shark fin antenna is going to be exclusive product which is going to be introduced in the customer. Second question you said in terms of the timing of this introduction. Is that correct understanding?
No, sir, I'll just repeat. Sorry, I hope my line is clear now. So first question is right. Are you the sole supplier, or you are making an entry into that product in that sense? You are a tier 2 supplier. Second, is it for a single model or on project basis, or is it for multiple models? And third, is it an import substitution product, or it is completely a new product that you have created? Was this product already there in the system and you are now replacing it?
So let me take the third question first. At least for the customer, we have got introduction. This is replacement of previous generation product. That means the pole, the pole type antenna. So that's going to be let's say a replacement or a new generation product introduction. Second, we are not, in large or the large customers do not introduce a single supplier. So there are going to be at least two vendors supplying the same. And third, the product is going to be today, the business order is for one particular model, but which is for our, let's say, preferred situation. It is going to be almost the largest volume program. But considering the historical situation, we have noticed that these parts are commonized to take advantage of the pricing in long term, including tooling cost, reinvestment being avoided. So we are hopeful that we may have opportunity to introduce this part in other programs. But as of now, to answer your question, this is for a specific program. I hope I answer all the questions.
This is the import. Yes, it is an import substitute. Most of the customer import this at the moment, and this is going to introduce in all the segment over a period and all the category of the vehicles.
Oh, this is very interesting. If it scales up, it could be a reasonably big business for us. And second was in the wiring harness domestic side. Today, who would be your key competitor today? You expecting the BS6 today? Who is the competitor? Who would you benchmark yourself with on the wiring harness side?
In the WH segment, this is by sector. So we have multiple competitors. This is becoming a commodity space, to be frank. So two-wheeler is going to be another three dominant players, including us. We have commercial vehicle. There are another two important competitors. We have tractor, which is a lot of complication, but very crude wire harness relatively. So you have more competition there, including next to the plant kind of wire harness, those who are supplying to them for over the last 30-40 years. PV is the most, let's say, organized one, including its technology. But I'm pleased to say that in with BS4, BS6 transition, recognition of Minda Corporation as one of the most reliable wire harness supplier is there among two-wheeler, among commercial vehicles, equally and substantially. But I don't want to go specific to my competitor's name in this case. I'm sure, unless that is a very specific question which you would like me to address to.
No, this is very helpful. And so just a clarification, the shark fin antenna, just if I can. So this is for a particular OEM, right? This technology, it cannot be used for some other OEM, right? I presume that is the arrangement.
No, so let's make it more. So the product per se, the patented design of external shape is going to be unique. But there are about 4 or 5 different varieties of feature application which are going to be possibly offered in future if they would like us to expand more with the higher end technological product in their product range. However, the basic design of the product can be utilized with the specific model-related design requirement of particular customer. So to answer the question, generic interior design, unique for particular model which requires to be developed. We have competency for both.
Okay.
So this can be expanded to other customers easily. This is what we, as far as the product range is concerned, without very significant investment, other than volume expansion requirement of CapEx, I think the technology can be horizontally deployed with other customers also.
Thank you.
Thank you. Ladies and gentlemen, due to time constraint, we'll take that as a last question. I would now like to hand the conference over to the management for closing comments.
So, this financial year 21 will be a challenging year, but we are confident that the worst time worst is behind us. I can assure you that Minda Corporation, with its unique value proposition, research and development driven products, support from customer base, and a strong balance sheet, is well placed to navigate through these difficult times. With this, I thank everyone for joining on the call, and please keep safe. Thank you. Thank you very much.